much. Let's get into this report, the reaction that we're seeing play out in the equities markets, also the bond markets. For that, we want to bring in Stephen Juneau. He's Bank of America Securities U.S. economist. It's great to have you here. So just the first reaction to this hotter than expected inflation print that we got out here this morning. What do you think this signals then for the Fed? Is it enough to potentially delay cuts?
I don't think it's enough to delay cuts. So I think, it was about in line with kind of the ballpark of our estimates. It's about a few basis points off in terms of our core print. So really, I would say for the Fed, we're looking for a March cut to kind of kick off the cutting cycle. This kind of keeps the door open. It definitely doesn't slam the door shut. If we had seen something like a 0.4% on core, one of the big reasons for the firmer print is that, at least relative to our expectations, is that used car prices actually increased. We were looking for a decrease there. But we know that declines in used car prices are in the pipeline. So if we didn't get them this month, we're probably going to get them in January or February. So you're going to see that kind of come off. The big concern for the Fed, I think, is that there's still this dichotomy in the data. Core goods prices are deflating. You still saw that again this month. That's supply side driven. It's not necessarily driven by the Fed. But core services remain firm and shelter really remains firm. And we really need to see progress on services to really feel confident that we're going to get back down to 2% on a persistent basis. But that doesn't mean that the Fed can't start to gradually kind of ease off their restrictive stance.
Steve, I want to linger on that firmness that you were mentioning and that we brought up at the top of the reading here on shelter particularly. Where do you believe or when perhaps do you believe that some of the Fed's policy will actually trickle through to the shelter part of this?
Yeah, so shelter is an interesting one, and we've been waiting for it to happen. I think what we're learning is that kind of, if you're on the rental market today, if you're, looking to rent a new apartment today, you're looking at more attractive rental inflation. You're finding discounts out there. There's a lot of supply on the market. But the issue is when you're talking about the CPI methodology, when you think about the contract rents, it's the average rents that everyone's facing. Well, what we're learning is that lag between asking rents, what a new renter is facing, and CPI rents, well, it's a little bit longer than we expected it to be. So when will we see it? It's $1 million question. We're still trying to figure it out. We think it's going to happen gradually. I think what you're seeing fundamentally is that the Northeast is still an area of strength in terms of rent inflation. The rest of the country has ample supply. It's adding a lot of supply, and you're seeing kind of more discounting there. So it's really kind of this regional dynamics, and that can lead to maybe firmer prints on shelter. So it could take some time.
Actually, that's what I was about to follow on. Is this as simple as more capacity being brought online to then in some of the more expensive rent or owner's equity rent kind of equivalents, if you will, as more capacity comes online, the common thinking is that, supply and demand characteristics would say pricing would come down. But is as simple as that at the end of the day?
Yeah, absolutely. If it were a simple thing to add rental supply, then I think it would be as simple as that. I think the issue is where you are adding rental supply, which is kind of in the South, in the West, in the Sun Belt. You are seeing rent prices come down. You see it in the CPI data still. Where you're not seeing rental supply really being added, the Northeast, right? It's more landlocked, it's more developed, there's greater density. Those areas, well, you're seeing still firmness there. You're also probably seeing some return of population to those areas from prior to the pandemic, right? You had kind of that outward movement during the pandemic, and now those people are starting to come back. So that probably boosts the demand picture there.
Stephen, what are some of the seasonality factors that we need to keep in mind, especially when you take into account or take a look at where we did see some of the pricing increases last month, airfares being one of them? It was during the peak holiday travel season. So put that in perspective for us and how you're taking that into account when you're making your forecasts.
Yeah, that's a great question. So, what we do is we always take the seasonal factors into account, and airfares has a large seasonal factor in December. So that probably helps explain that. Really, when you look at, say, non-seasonally adjusted data, airfares were actually down on the month. So when you just look at domestic average ticket prices, so it's really kind of the seasonal factor that's probably contributing to that rise. And maybe what that means kind of as we go forward, airfares is a small component of the basket. But what that might mean as we go forward is maybe January and February softer than December.
One of the other areas that we have to continue to keep a close eye on, and it's come up as an investment thesis that we've discussed with some people in the healthcare sector, specifically medical care indexes rose by about 0.6% in December, about the same as it did in November, roughly. Hospital services increasing. We saw a prescription drugs index actually fell 0.4%. Perhaps that could be mechanisms of more competition that's entering into the market here. But that is a service that people are going to need to continue to buy into one way or another. How sticky is that element within future readings from your anticipation?
I definitely think there's some stickiness there. I mean, it's always going to be something in demand. When you think about kind of the structural demand forces for medical care, well, we have an aging population. So the demand for kind of medical care services, that's just going to keep going up. And we are seeing kind of rapid hiring in that sector, relatively strong wage inflation as well. So there is room for firmness there, definitely. Where you have to be careful, I think, in the CPI data is there's just some methodological quirks around the health insurance calculation. So that's part of the story there. Why you saw kind of weaker readings last year was really due to the health insurance component and how BLS really goes about calculating it. And this year, the health insurance, how they calculate it is just a little bit more positive. So that kind of contributes to what we've seen over the past 4 months or so. But getting to your point on, say, hospital services, physician services, I think that's kind of structurally something that we'll continue to deal with. Healthcare costs are expensive.
And Stephen, squaring this with the jobless claims numbers that we also just got out here a few moments ago, coming in at 202,000, lower than what the street had been expecting. So when you take that into account, the fact that the labor market has been holding up now and remains tight pretty much, and then you compare that to the stickiness that we're seeing in inflation, how do you think the Fed is looking at that most recent data? And then looking ahead, what do you think are the key data points that investors need to keep a very close eye on?
So I think inflation is still probably the biggest focus when you're talking about kind of the timing of the first cut. We need to see, we've obviously seen with core PCE inflation over the last 6 months on an annualized basis, we're running at 1.9%, right? That's slightly below the Fed's target. So I think where we're getting is some progress there. So we need to just see that continuation. If they see that over the next couple of months, March is certainly open for a cut, and that's what we think will happen, right? So we think they'll kick off the cutting cycle there. Now, when it comes to the pace of the cutting cycle, that is where I think the labor market plays in for the Fed. So obviously with the claims data, we're still seeing, really good claims numbers. We're not seeing layoffs. That's consistent with the JOLTS data. When you looked at the NFP data from December, you're still seeing strong hiring, rapid hiring there. It's narrowly driven, of course, but it is still positive. The unemployment rate's still below. So that is why the Fed, we think, will be gradual in this cutting cycle, right? Because you still have this tight labor market. You have to worry about kind of those fundamental drivers of wage inflation supporting kind of inflation getting stuck maybe a little bit above 2%. Wage inflation isn't too high, right? It's running at 4%. So maybe that's consistent with 3% inflation. But, I think the labor market really dictates maybe the pace of the cutting cycle. Do we see sequential cuts? Do we see a 50 basis point cut? That's where the labor market, I think, really comes into play. If we see significant kind of deterioration in labor demand, which we aren't seeing, obviously, the claims data is a great leading indicator for that, then that's where the Fed can get a little bit more worried about the economic outcome and really start to cut more quickly.
Steve, always a pleasure to get some of your insights and put some more color around the data that have come forward. Stephen Juneau, who is the Bank of America Global Research U.S. economist. Thanks so much.
Thanks for having me on.